Hi guys, today we'll be talking about liquidity engineering, and you're wondering what liquidity engineering is. First, the market does not move randomly, and every movement happens because buyers and sellers interact. To understand this better, we need to understand concept known as liquidity engineering. So this is where liquidity engineering comes in. Liquidity engineering first is the idea that market movement is influenced by where buyers and sellers' interest exists. That is, where whatever point the buyer's interest is at or the seller's interest is at or where they both exist at is actually an area of interest. And those can actually pull liquidity, like I already stated in my other liquidity videos concerning liquidity, right? So market actually moves towards these areas because there are lots of orders available, because that's where transaction can take place. Premium and the discount levels, those are where transaction can take place. Do you understand? So this doesn't mean someone is controlling every move. It simply reflects how market functions, right? And why order matters is every trade requires both a buyer and a seller. There's no buyer without a seller, there's no seller without a buyer, right? So I need you to look at it in real sense. There's no market. If you want to apply this into the real life outside of the charts, right? There's no market without buyers and sellers. When you go to the market, when you go to the grocery store, wherever you go to, right? There has to be someone willing to sell to you for you to be able to buy. And there has to be someone willing to buy for you to be able to sell, right? So that's exactly how the market is. And you have to understand all of this, which is why we have demand and supply. You have to understand this concept very well so you get to see trade from a very different angle than just the charts and buyers and sellers and liquidity and people talking about double highs and double lows. Those are very important parts, right? They actually give us signals or give us a hand at what could be happening or what is happening in the market at a certain time. But you have to look at it from the real scenarios to actually understand it from another perspective. Now, large participants often need enough available orders to enter or exit sizable positions. Areas with greater trading interest can provide more opportunities for those transactions. So, many people need to understand that for trade to go on a certain direction, there has to be large numbers of orders. For price to go whatever direction, there has to be a large size of positions for this transaction to be able to happen. So where does liquidity lie? It's always at the previous highs, the previous lows, the equal highs, the equal lows, the support, the resistance, the supply, the demand, round psychological price levels. Do you understand? So they're what we call the psychological price levels, which are round whole numbers. Whole numbers. When you see certain areas like, let me use gold as an instance because it's a very traded pair, right? Let me use gold as an instance, a very traded asset, right? So what I would say is, when you see gold at certain prices like 4,000, like 5,000, like 3,500, like 3,100, you know, when I say a whole number, like 3,200, like 3,900, you know, those whole numbers, I want you to go to your charts and look at where this number lies, and you can see that when price gets to those points, they usually stall for a while. Or when they get to those points, they either buy aggressively or they sell aggressively or they stall. When I say stall, they consolidate, right? So if you go there, you notice all of these things. After this video, I want you to go check it and you actually confirm it. This is what I mean by round psychological price levels, right? Now, these are areas where many traders place pending orders or stop loss orders. And why price doesn't move in straight lines you would wonder, right? We all know what price don't move in straight lines. When you have an impulsive move, there's always a corrective move, which is the pullbacks and then the continuation, and then it just keeps ranging, and then we have a wave of trends, right? The market constantly searches for balance between buyers and sellers, and that is why we always have the impulsive and the corrective move. So buyers buy, and then we have the pullback, and then they sell, right? Now, as new orders enter the market, price adjusts accordingly, and this is one reason why markets often move in waves rather than straight lines. But when price moves, price has to return to correct the imbalances, and that's why we have waves, right? So let me give you this in real life scenario, right? A company produces products, and then they produce and produce and produce, right? They get to sell and sell to the wholesaler or the retailers, right? And then when they sell to the wholesalers or to the retailers and the wholesalers buy, right? So when everybody's buying and buying and buying, the company is making so much money, right? The demand is high, so the price is going up and up and up, right? Because of the demand. And then the retailers and the wholesalers have to buy, right? Now when they keep buying and buying and buying and buying, there would be an imbalance if there are no customers to buy these goods from the retailers or the wholesalers. Now you buy a large sum of goods from the company price has pumped up, revenue is high, demand is high, price is up. Now retailers have these goods, which is where the advantage comes in, because the more the demand, the higher the price gets, and the people buying from a very discounted price would actually have more advantage over the increase in price because they bought early, right? That's exactly how trading is. And then now there'll be an imbalance if after buying this much, there are no customers to sell it to. I don't know if you're getting me. There are no customers to sell it to, so there'll be an imbalance. Because what am I supposed to do with those goods that I bought if I don't have anybody to sell them with? They're either going to spoil, which I'm going to lose money. It's going to be bad market for me, and probably I might not even buy from the company again, depending if it was because of the product, right? That's exactly how trading is. So when they buy, price goes up. People that bought at discounted prices have the advantage over the increment in the price, right? So when you keep buying and buying and buying and buying, it's very unreasonable that it doesn't sell. So you have to sell. And the more the buyers outside, the wholesalers and the retailers sell, the price is going to drop, right? Because demand has been met. The high demand has been met. It's been met, so the price is going to drop. It's going to pull back. And that's where those pullback come in, because the consumer's demand has been met. It will pull back because they're selling off now. The buyers are selling, right? Consumers' demand are met. Demand will drop, and then it pulls back, creating a supply. Which, if you apply it to real sense in your chart, it pulls back. It creates a supply, and that's exactly what happens. The sell-off that the retailers and wholesalers do actually causes it's supply, right? So for them to sell at very large extent, right, it has to create a supply because they're supplying to the consumers, to the end users, to whoever, but they're selling off, right? It creates a supply. Price, the more they sell off, the more the price reduces, right? And then as the price reduces, that's exactly the retracement. And now it's created a supply because they are giving, is why the price has to drop. Because the more they give, the less the demand now. So the less the demand, the more it's likely for price to pull back to the point of demand, which is exactly where the retailers bought it at. And that's exactly what happens in the chart. Do you understand? So you have to look at this from that sense. That's why I said sometimes you have to change the way you think and put it in real life scenarios, and you actually give you a very better understanding of what's happening in the market, and you can use that to your advantage. Now there are concepts that you need to understand, and there are concepts like what I'm teaching right now, the liquidity engineering. This actually helps you to identify area of interest, improves your patience, avoid emotional entries, and combine liquidity, market structure, and other confirmations, right? And it's a framework for understanding market behavior and not just a prediction tool, right? Which is why I said you cannot single-handedly use it. Most people do use it, but they also add very slight things to it. You cannot just use it like that. You have to have other confluences or confirmation to it. Market structure should always be top. You can never let go of that. And now the mistakes that many people make and is believing that liquidity engineering means every market move is manipulative or manipulated, and that's not true. Most people just say that every liquidity engineering means that the market is being manipulated, and that's not true. Markets are influenced by millions of participants making decisions based on different objectives. Liquidity is one important factor among those objectives. So instead of thinking the market is trying to trick me, I want you to start to think like this. The market is moving towards areas where buying and selling activities is concentrated. This mindset is more likely objective and help you analyze price without emotions. I will say that again. Instead of thinking, oh, the market is moving towards the liquidity point after you identify it, the market is trying to trick me or manipulate me into entering or liquidate me. I want you to think of it like this. The market is moving towards areas where buying and selling is highly concentrated. Do you understand? Where buying and selling activity is highly concentrated. That's all the market is doing. There's a lot of buys or sells depending on what direction it's moving to, and there's a lot, and that's what's pulling it. I need you to think from that point, not, oh, I don't understand what market is doing, they're trying to liquidate me, they're trying to manipulate me. Many people start to tell you of accumulation, manipulation, distribution. Okay, good. I'm not trying to debunk any concept that already exists, but I'm trying to help you understand better and see things with clearer view. Yeah, and that'll be all. So do subscribe, like, share, and I'll see you in my next video.